Welcome to Talk Tickers, where we break down the earnings calls that are moving the market. Today, we're jumping into Carvana's Q4 2025 earnings, and look, on the surface, this was a quarter of absolute record growth. But then, after the bell rang on February 18th, the entire narrative just fell apart. And this is what happened. The stock just cratered, dropping over 22% in after-hours trading. We're talking about a move from over $360 a share all the way down to around $280. Now, this wasn't just some minor pullback, it was a massive cliff dive of a sell-off that had everyone asking one question. So what was the market saying here? You've got this incredible growth story on one hand, and an overwhelmingly negative reaction on the other. It just doesn't seem to add up. So our job today is to dig into the call, look past the headlines, and figure out exactly why investors hit the panic button.
Okay, so let's get into it. The real story behind that 22% drop isn't in the press release headlines. It's buried in the details of the earnings report itself.
And what you find when you look closer is a classic mixed bag. Yeah, the big numbers, the top-line figures, they look fantastic. But the actual quality of those earnings and the economics of each car they sold? Well, that tells a very, very different story.
And here's where the confusion started for a lot of people. The official GAAP earnings per share was $4.22, a huge beat. But, and this is a big but, that number got a massive artificial boost from a one-time non-cash tax benefit of nearly $618 million. Once you strip that out, you get to the adjusted EPS, which was actually a slight miss. The market saw right through that headline number. Now, let's move over to the key metrics. Revenue, a solid beat at $5.6 billion, which is up an incredible 58% from last year. And retail units sold, they surged by 43%. Both fantastic numbers, right? But look at adjusted EBITDA. It came in at $511 million, missing Wall Street's target. And that right there, that's the first real crack in the armor. So this brings us right to the heart of the puzzle. With cars flying off the lots and revenues soaring, why did everyone rush for the exits? The answer isn't about what they sold, it's about the cost of selling it, and even more importantly, what they signaled was coming next. And this really gets to the core conflict of the whole quarter. On one side, you had management painting this incredible long-term picture. But on the other, you had investors who were laser-focused on the hard numbers of right now. So on the call, CEO Ernie Garcia was incredibly bullish. He was talking about the company's massive long-term goals for 2030 and beyond. This is the grand vision, right? To become the biggest and most profitable auto retailer on the planet. But here's the thing. The market wasn't trading on 2030, it was trading on Q4 2025 and what's coming in Q1 2026. And what it saw were some serious near-term problems. Costs to recondition their cars were going up, they were taking a hit on retail depreciation, and their gross profit per unit, or GPU, actually declined by $244 year over year. That's not the direction you want to see. And management basically confirmed everyone's fears. They admitted on the call that these cost pressures, especially in reconditioning, were probably going to stick around into the first quarter of 2026. That one statement, it just injected a huge dose of uncertainty into the whole story. Okay, so this is where guidance becomes absolutely critical. For a high-growth company like Carvana, which trades at a really premium valuation, the forecast for the next year is arguably the single most important piece of information they can give. And this was their guidance. We expect significant growth. I mean, it sounds good, right? But for Wall Street analysts, this was anything but. And here's why that was such a big deal. For the analysts who have to build these complex financial models, the word significant is, well, it's useless. They needed a hard numeric range for revenue and EBITDA. Without it, you can't build a forecast. And when Wall Street can't forecast, it sells. That lack of specificity was a major, major red flag. So, with all that context, here's our take on the situation. Let's talk about what investors really need to be watching for in Carvana's next earnings call to see if they're actually getting this ship turned around. All right, here's what's going to matter for Q1 2026. First, GPU stabilization. We have to see that decline and per-unit profits stop, flat out. Second, they need to give clearer guidance for the full year. We need actual numbers, not just vague adjectives. And third, we need to see proof of cost control. They have to show that those reconditioning expenses are being managed. So what's our prediction for the stock price? Well, it's pretty straightforward.
The stock is probably going to stay volatile and under a lot of pressure until the company can prove that these near-term execution problems are solved. The long-term story is still great, but right now it is all about execution.
And that brings us to our final rating for the stock. Market perform.
Here's the thinking behind that. Carvana's long-term growth story? It's still compelling. It's still very much intact. But right now, it's being completely overshadowed by these near-term risks, the uncertainty around their profit margins, and this guidance vacuum that the market just can't ignore. You could say the bull case is on pause until the company proves it can manage its costs at this massive scale.
This analysis is for informational purposes only and is not financial advice.